Murray Income invests in a diversified selection of high-quality companies. 80% of the portfolio is invested in large and mid-cap companies listed in the UK, and 20% of the portfolio, which is our limit, is invested in world-class overseas listed companies. As an income fund, we want the portfolio to generate a healthy level of income and for the dividend to grow. And indeed, the dividend yield is currently just under 4.5%, and the company has a track record of 50 consecutive years of dividend increases. I like to explain the investment process as the 3Ds. We want to be dependable, diversified, and differentiated. Firstly, being dependable by investing in high-quality businesses with long-term structural growth opportunities and resilient income streams. We take a patient buy and hold approach, allowing the fundamentals to win through over time. Secondly, being diversified. We don't want to put all of our eggs in just one basket. So the portfolio of around 50 companies is diversified in terms of capital and income and by sector. Diversification also comes from holding mid-cap companies and overseas listed companies. Thirdly, differentiation. We believe that in the UK equity income sector, we're differentiated by our emphasis on good quality companies, our thoughtful, diversified exposure, the mid-cap and overseas listed holdings, a focus on ESG, and our 50-year track record of dividend growth. Well, we try to manage risks in general through our in-depth stock analysis, the focus on good quality companies, the diversification in the portfolio from both an income and capital perspective, and we keep a keen eye on the liquidity of the holdings. We do have some gearing, but this is modest at less than 10%. One risk, albeit this is the case with virtually all UK equity income funds, unless they invest solely in companies that generate all of their income in the UK, is that given the international nature of earnings for UK listed companies, those companies that pay their dividends in non-sterling currencies and or generate profits overseas would be impacted by a significant strengthening of sterling. As an investment trust, we have generous revenue reserves, which if required, could help maintain our long-term track record of dividend growth. In our stock analysis, we analyse the risks and opportunities that a company faces from an ESG perspective. We won't invest in companies where those ESG risks jeopardise the investment case. So, for example, we don't invest in tobacco. The portfolio is rated as AA by MSCI for its ESG credentials, and based on their independent analysis, is in the top 1% of the UK equity income peer group. The trust has some gearing, nearly all of which is through longer-term loan notes, on which it is paying around 3.5%. The gearing level is a little under 10%, which is modest, particularly given the beta of the portfolio is normally less than 1, or in other words, it's less volatile than the market as a whole. The formal limit is 25% of NAV at the time of drawdown, and the gearing helps to gently amplify returns over the long term and is not employed on a more tactical short-term basis. Yes, the trust has a discount control mechanism, although the exact level at which the company will buy back shares isn't made public. That said, the company has been very active, having bought back about 5% of the shares during each of the last 2 financial years. So I think the fund has the potential to be the backbone or core of a wider portfolio. It provides a healthy dividend yield, with the dividend paid quarterly, and exposure to some great businesses at attractive valuations both in the UK and overseas that should be able to provide long-term earnings and dividend growth.